Is the maximum loss on a short call unlimited? Have you ever wondered about the risks involved in options trading, specifically when it comes to short calls? Let's break it down in a way that makes sense. In options trading, a short call occurs when you sell a call option. This means you give someone else the right to buy a stock from you at a specific price before a certain date. When you sell this option, you receive a premium, which is your immediate profit. But here's the catch. You also take on an obligation. If the buyer decides to exercise the option, you must sell the stock at the agreed strike price, regardless of how high the stock price has climbed. Now let's talk about risk. If the stock price rises above the strike price, you are required to sell the stock at that lower price. Since stock prices can theoretically rise indefinitely, the potential loss on a short call is considered unlimited. Imagine having to buy the stock at a much higher market price just to fulfill your obligation. This situation can lead to significant financial loss. If you do not own the underlying stock when you sell the call option, this is known as a naked short call. The risk here is truly unlimited because you may have to purchase the stock at any price to meet your obligation if the option is exercised. On the other hand, if you own the stock, this is referred to as a covered call. In this case, your risk is limited to the price you paid for the stock minus the premium you received. This distinction is essential for managing risk effectively. Let's clarify some terms to ensure we are on the same page. A short call is when you sell a call option, obligating you to sell the stock at the strike price if the buyer exercises the option. The premium is the money you earn for selling the option. A naked short call is selling a call option without owning the stock, while a covered call is selling a call option while owning the stock. In practice, traders often use short calls when they believe the stock price will not exceed the strike price. They collect the premium and hope the option expires worthless. However, the risk of unlimited loss with a naked short call makes it a high-risk strategy. Covered calls are generally safer because your loss is limited to your initial investment minus the premium received. So, to answer the question, yes, the maximum loss on a short call is indeed unlimited if you do not own the underlying stock. If you do own the stock, your maximum loss is limited to the purchase price of the stock minus the premium received. Understanding this difference is vital for effective risk management in options trading.